Welcome back. Morning market briefing. It's Tuesday, September 7th, 2022. The boys are back in town. Actually, the boys have been back in town for a little bit, but the boys were locked out of the office yesterday morning. Got here about 6:15, and our battery-powered keypad to unlock the deadbolt had died. I don't know. So this lady came out and drilled the door for a while, and then we got in. So other than that,
she definitely earned her wage. She was grinding on that lock. Literally and figuratively.
Yeah, it was a tough situation, but we got in actually right after the call would have happened. And anyway, we're here. Tom, we're going to recap the event of the season, which was Ben Nye's wedding at the end of this call. But we got a lot to catch up on. Really, over the last 6 trading days, we've seen quite a bit of volatility, and volatility, of course, is a fancy word. When we say that, we mean bad things in the market. S&P down about 5.5%. Bonds having some trouble. 10-year yields climbing up close to 4%. Kind of a sell everything market. Obviously, we were following the market even when we were out of town. I was back in the office Friday. You were in the office with me yesterday. What are you seeing thematically, and kind of to people out there just at a high level? How would you summarize the last 6 days?
I think it's a gross overreaction. And I think we're seeing a little bit of that retracement this morning. We're seeing futures up, almost 1.5% on the S&P, over 1% on the Dow. We're seeing the 10-year drop precipitously. That was the biggest move I've seen in the 10-year Treasury, I think, in my career in a 5-day period. We topped out yesterday at 392, which is the highest it's ever been in my career that I can recall. It is very, very, very high. And that was moved from a 349 before we left. So almost, call it a 1/7 move. A huge move in terms of total yields skyrocketing. We've already seen about half that come back down. We're at like a 377 right now. I think there's a number of things at play. I think one is that we are not in a current period where stocks can be bought back by companies. And I think a lot of that really helps stabilize markets. It's a number of people who are actively buying a lot of the major stocks every single day. If there's any sort of downturn because they think they're at a level where they should be repurchased. And so since we're in the blackout period ahead of earnings, that can't be done. And so a number of huge market players are absent. And the less volume, the less players you have, the more wide you see prices move. Because it's almost like 2 trains pushing against each other. If one train has fewer cars, you just start moving in the other direction. If there's a lot of cars missing, you're just prone to move in the way that the market's feeling. So instead of a 1% down day, you might see 2% or 3% because there's just so few players. The bonds market's like that as well. I think the difference there is that people are really worried that, rates are going to go to 5-6%. I don't necessarily see that happening immediately. There is a possibility that if this thing really kind of spirals out of control with the hiking and interest rates, that could be the case. But I think that's, the fear is that this is not the end of the high point in rates. And I think we're a little oversold, at least for the short period there as well. So I think this is a good buying opportunity, stocks and bonds. But it's been rough. It's been a very bumpy couple of weeks.
Yeah, it's been painful. And I think 2 things I would highlight that you kind of touched on, Tom, on the equity side specifically. The share buyback thing is huge. And that's a big part. We've talked about this at length on the call, probably a couple months ago about the potential taxation of share buybacks. If that disincentivizes companies to buy their own stock back, that's going to have an adverse impact on market volume. When you hear these buyback programs from certain companies, they almost sound like funny money, like monopoly money, where it's like, oh, they've got a $100 billion share buyback program, or they're going to buy back $40 billion worth of shares. That doesn't really quantify, even to us. We work in the markets, but even to us, it doesn't always really resonate as that big of a deal. But if people are consistently taking shares off the table, they're in that market, and they're in there in a big way. It's a significant amount of volume that can fall off. The other thing I'm curious to see when it comes out, I do not have the data now, so I could be totally wrong on this. But humans are traditionally very, very poor allocators of capital. There's all kinds of surveys that show what the actual 401k and investment portfolio returns are by individual investors, and they're significantly lower than the market. They're significantly lower than almost any benchmark you can find over the long term, because people tend to sell at the wrong times, tend to buy at the wrong times. I'm very interested to see some of this 401k data in terms of allocations. We've talked a lot about what fund managers are doing and how they're positioned with a little more cash than normal, lighter on equities than traditionally they would be. We're probably getting an overreaction to an extreme on that level with individual investors in the 401k. So when that money's hitting the paycheck every Friday, it's not necessarily going into a balanced fund or an S&P 500 fund. It may actually be going into a money market, and that's going to hurt volume as well.
Yeah. I mean, the bond market's almost worse.
Yeah.
If you run a major bond fund, you have a couple $100 billion in bonds, and then people see the performance is bad and they say, well, I'm going to sell all my shares of your mutual fund. Well, if there's a large number of people doing that, you're now trying to sell illiquid bonds into an illiquid market with few buyers while rates are selling off. And, you basically have to take a 5, 6, 7% haircut on something that's already down 5, 6, 7%, and so these bonds are just flooding the market at prices that make no sense because there are no buyers. And that just pushes yields up like crazy. And it makes, people who are holding mutual funds, it puts you in a bad spot if you're not a current seller, because you've got to eat those losses too, equitably with the rest of the shareholders. So, even though the bond prices are falling and they're in your account, we know we're getting par back. We don't know that to be the case in mutual funds, because at some point someone can say, I'm selling, and then you are forced to sell as well.
So last week, the news, obviously the Fed raised rates 75 basis points. That occurred kind of right in the middle of Ben's wedding.
During the speeches.
Yeah. Shout out to Ben. Of all the people in the world I know that would potentially schedule a wedding during a Fed announcement on a Wednesday, Ben's last on the list.
Yeah.
And yet there we were. So thanks for that, Ben. It was interesting because there was a market reaction, maybe not a massive one that we've seen at times based on Fed commentary and things like that, but there was a reaction. And to your point about this kind of being a prolonged overreaction, I mean, the 75 basis points was exactly in line with what everybody was looking for. What are they looking for moving forward?
So right now, the bogey for the rest of the year is 5 hikes in terms of what futures are showing. So, I've said all along, I thought the benchmark should be 9. This is coming in at 8. So we're basically one short of where I think they probably will end up, at least in terms of where futures are trading. But it looks like 3 hikes for the next meeting, and then an additional 2 to end the year. And then going into next year, we start to get kind of flat. You basically see a potential for maybe 1, maybe 2 hikes in the first, sort of 5 months of next year. And then we see kind of a stall out at a potential cut starting in June. So, for context, when they first started talking about signaling cuts, they're talking about February. Now we're basically saying that we're going to continue to raise rates. It might just be 1 hike at a time, kind of in that January, February, March, and then we'll probably hold. And then assuming that they've successfully destroyed the economy, we will start to cut.
From a bond buying perspective, Tom, as you're thinking about that, hey, we've got, half a dozen or so rate increases coming, probably more, a potential cut. How do you kind of balance out the desire to really maximize yield, but also be mindful of, hey, this is so much better than anything we've seen, and these predictions could be wrong?
I mean, for me, it's really about making sure that we're getting cleaner stuff. Right now, yesterday you could see stuff that you'd never, ever see. Stuff like Georgia State GOs trading very, very cheap to the market, with, shorter and shorter calls, shorter and shorter final maturities at levels that we haven't seen in years. And for me, it's about return of capital, right? So even if rates go to 6%, right, call it in the next year or so, it's still a great time to have something locked in at 4% tax-free that's going to mature in a year, because if it matures in a year, then you can take advantage of that 6%. And if not, you've got other bonds that you've bought that are going to continue to roll down for the next couple of years. And so, we're just buying the best available, making sure we're getting very, very clean on credit quality. Because at the end of the day, if you make 4% or you make 6% or you make 8% on a bond, as long as it doesn't default, you made money and you took on exceptionally low risk, right? So it's not about hitting home runs. It's about guaranteeing that you get your money back because you've done the credit legwork. You're buying the best available bonds for the time. And anything we buy is going to be leaps and bounds better than it was last year, 2 years ago, 5 years ago. And so these are going to be good bonds to hold, especially if you can lock in for the long term, because my expectation is that at some point the Fed's going to start cutting and these bonds are going to start to price up significantly. But is it 1 year? Is it 2 years? It's almost impossible to know at this point.
Don't get too cute. In other words,
yeah.
Focus on what's the best available. Make the move that you can, and be content with the credit work you've done.
Yeah.
Excellent. UK, where we just were, massive cut in taxes. This is the largest tax cut they've announced since the early 70s. Pretty interesting, timing on this. This is certainly not going to be something that's necessarily going to help with the inflation story. If anything, it's going to create significant upward pressure there. There is, according to the Institute of Fiscal Studies, quote, not even a semblance of an effort to make the public finance number add up. Tom, interesting timing on this. I did feel, we talked a little bit about this just a moment ago. We were in Scotland. Some other folks from the office bounced around a little more and went other places, but the economy seemed pretty fine. Food and beverage was so cheap there. I don't know if it's very expensive compared to what it was a year ago. Maybe it is, but to us, it seemed very, very cheap. But they're just trying to do anything they can to keep things humming.
Yeah, it was interesting because I would say, having been to both France and the UK in the last month, that France seemed like they were having a little bit more trouble. We talked about the lights being off completely in the hallways at hotels. I did not see that. I stayed at a couple different hotels in Scotland. Did not see that really being the case. It didn't seem like things were as expensive there. It didn't seem like things were as austere there in Scotland. And things were very, very cheap. And a lot of that has to do with the fact that the pound has just plummeted.
Yep.
My baggage was lost. And so I ended up having to buy a suit while I was there. And I got a suit, shoes, belt, 2 dress shirts, a tie, pretty much the entire outfit. It was like
underpants.
Yeah, I got some Cristiano Ronaldo branded boxer briefs at the counter there, which is a good buy in my opinion. Though I will say that the XL is not so L. European sizes are quite small. But I mean, it was like $200 and luckily Delta covered the cost of that. But I mean, you'd be hard pressed to find a $200 suit in the US at this point, even if you're going to Nordstrom Rack, I feel like.
Yeah.
And so the pricing thing is interesting. So you wonder what the prices were before, but the pound dropping obviously makes it better for us. But it didn't seem as dire as it seems. But of course, they announced this on Friday. I was at the airport. I actually had picked up a copy of the Scotsman off an empty seat at the airport, which is the national newspaper. And this was the front page news, was that everyone was panicking because while tax cuts are awesome, it basically is going to be all funded by debt. And that basically is the same as cutting rates heading into, they were talking about inflation being as high as 15% as soon as, October, November. And so this is not going to help. And, Larry Summers came out and said England is an emerging market turning into a submerging market, meaning that they're sinking into the sea. So we'll see how it goes. But they basically went from one of the best handlers of COVID and fiscal policy and their early movers to suddenly they're just, I don't know what they're doing. It doesn't add up. Like the Institute of Fiscal Studies says, they can't make even the slightest effort to make the numbers add up. So UK, probably stay away for the time being, just until they can figure out what they're doing on the fiscal side, because it looks like their inflation is about to skyrocket.
Good stuff. Yeah, we are seeing a rebound today, which is great. No coincidence. The boys get back on the morning call and the market decides, hey, it's time to play nice again. US 10-year yield down about 10 basis points on the futures side. For equities, Dow futures up 1.1%, S&P up 1.4%, NASDAQ futures up close to 1.7%. Let's give the people what they want, Tom. Let's recap wedding weekend. Tom and I and my wife flew out together. Nice little team bonding trip. Flew out Sunday evening of last week. Got to Scotland at like 11:30 on Monday morning. Just grinded it out, hit some pubs. Any major takeaways culturally?
I would say, having spent a lot of time in the UK and Ireland, that the Scottish people are not as warm as Irish people. They're a little more gruff. I did go into one pub by myself early in the trip, and I was not acknowledged for like the first 15 minutes. But the wildest thing was I was sitting next to a pair of adult male twins who looked exactly the same, and they were only talking to each other, which was a first for me in terms of like Twilight Zone. It was just really weird. I was not being served at a bar, sitting next to like 2 28-year-old men who looked exactly the same, who were only talking to each other. was very bizarre.
Just bros being bros,
Just
man.
bros being, yeah, literally.
We stumbled into a pub to watch the end of the Queen's funeral service. That was a weird moment. We had dogs asleep on the ground, and it was dead silent outside of people weeping.
Like openly weeping.
Yeah, it was very odd. I don't know, it was a unique cultural thing, just kind of seeing the way the death of the Queen impacted at least the 10 or 12 people in this particular pub. It was so quiet that when you put down your beer mug, you kind of looked around because it kind of echoed. Meanwhile, as everyone's crying, watching this essentially a church service, there's a sign under the TV that says, "Let's drink alcohol and talk shite." So
yeah, it was a very weird place to be.
It was a weird vibe. The wedding itself was at a castle. Ben looked absolutely dashing, I would say, very well put together. He was a maniac on the dance floor, could not get that guy off the dance floor. I mean, he was having the time of his life.
Yeah, it was an awesome wedding. So it was in a tower in an old castle from the 1400s, which is pretty wild. And it's the first and only wedding I've ever been to where there was a safety meeting ahead of time.
Yeah.
Because there were open candles in a very flammable seeming room, and it was a very tight quarters. And we
were basically in a stick of dynamite.
Yeah. Yeah. And there was a very tight medieval staircase, just as you would imagine it, with stone steps, very tight. And so they basically were like, if there's a fire, we're going to start blowing these air horns, and you guys just have to move quietly, and hope for the best.
Yeah. There was zero chance of surviving for your boy. It was very tight. I could barely get out of my chair. It would have been tough for me to survive that one. I was, went ahead and texted the family and was like, "Hey, at Ben's wedding, if I don't see you again." It was a good run, Mom and Dad. No, it was great. We had a great time. I got to meet a lot of Ben's family. Ben and Julia looked great. They had a great time. They are on their honeymoon there in Greece, I think. So Ben's back. I think he gets back Saturday. He'll be back in the office Monday. Other than that, I mean, we'll keep grinding on the calls. Hopefully we don't get locked out again, but calls the rest of the week. And then we'll have Ben back with the squad Monday morning. So we'll keep pushing ahead.
Thanks, everybody. We'll see you tomorrow. If you have questions, also, we got a couple texts, both while we're over abroad and the last couple of days. If you have questions, definitely shoot us in. We'll happy to be working into the call this week. I know it's been volatile and there's a lot of movement. So if there's anything jumping out at you specifically, please let us know and we'll address it on the call. Yeah.
And if you have concerns about just the out of the office thing, international travel, man, really not my thing. I last flew to a foreign country when I was 11 years old. Actually went to Scotland then. Not a lot of upgrades to Edinburgh since then. I mean, the buildings still look kind of old and made out of stone. They really hadn't done a lot of renovation of the castle. But we'll be around for the foreseeable future, and we'll get Ben back in the fold, and we'll get his take on everything he saw in Europe, and maybe get some economic analysis from Ben Nye, the investing guy. But we'll talk to you guys soon.